Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions featuring the proprietary bull-bear point and figure market breadth summary chart for January 13th, 2019. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.18 rose from 0.46 last week. The total count of securities in bullish or bearish patterns increased 7% to 3,236. The count of bearish stocks decreased 28%, while the count of stocks in bullish patterns increased 84%. The Pirls PNF market breadth summary chart shows us a market now 1 week in bullish territory. Paid subscribers have access to the Open Office Calc data from which this chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 461 points for the 7th advance in 18 weeks. At a negative 651.64 points, it continues below all 8 tops above plus 100 in the last 30 months, and it has risen above the October 2018 low, and continues below 3 of the 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily, with 5 days above zero, but still technically in a Woody's downtrend, is now at a positive 93.79, up from negative 16.48 last week. The CCI 20 daily is outside the plus or minus 50 range and will need to fall back into that range in order to form a zero-line reject long entry point after the Woody's trend changes to up on Monday, 1/14. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's downtrend 8 weeks ago, while the daily CCI 20 began a Woody's downtrend 13 weeks ago. The CCI 20 weekly in a Woody's downtrend rose to negative 71.10 from a negative 177.31 last week. It continues outside the plus or minus 50 range required for a valid zero-line reject short entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are also positive. Summary: oil and oil services on the top, gold and silver and some tech on the bottom. Bullish, gold and silver has entered the bottom 5. REITs has left the bottom 5. Disk drives and computer hardware have left the bottom 5. Bearish, comp tech continues in the bottom 5. Oil has entered the top 5. Oil services continues in the top 5. Focus this week from www.northmantrader.com. Return to the Crime Scene by Sven Henrik. The following are some key points. We recommend viewing the multiple excellent charts on the www.northmantrader.com website. Markets have returned to the scene of the crime, and participants act like nothing's happened. Treasury Secretary Mnuchin's emergency calls just before the lows, followed up by over a dozen dovish speeches and appearances by FOMC members on the heels of the now famous Powell cave on January 4th, had an immediate and violent reaction in credit and stock markets. No chart probably better highlights this point than that of high-yield credit. Whether words, and that's all there has been so far, are enough remains to be seen. After all, QT remains on schedule, although the Fed's rate hike schedule is over for now, again. And right at this moment in time, the observable fact remains: when markets drop hard, the Fed reacts, either in policy action or in words. And the Fed has reacted by pausing the rate hike schedule away from the advertised rate hike schedule for 2019. In short, they have altered policy by managing expectations, again, because that's what you do when unemployment is below. However, if you take a long view of markets, maybe things are not so awesome. Well, what's it look like? Sven Henrik, January 11th, 2019. This is a view that suggests that this market is technically broken and that markets have topped and look to pursue a historical path with a recession and a larger bear market to emerge. And this view is not only supported by the break of log trend lines, but also by the concurrent rejection of the 10-year yield at its multi-decade trend line. To reiterate, despite the speed of this move, nothing here so far is surprising. We moved into technical reconnects, and there is room to connect higher still into MAs, gap fills, etc. And while we have some short-term overbought readings, there's nothing overbought on the 2-hour, daily, or weekly time frames. Indeed, many of these have plenty of room to run to the point where this move can go on for some time. Add a China deal and SPX could be back at the 2750 to 2800 zone in a flash. Fact is, markets have begun to enter a significant zone of resistance. WLSH, NYSE, DJIA. Key indices are approaching key MAs, trend lines, gap fills, and previous support, all of which are technical resistance. It is what happens from there that will be key to determine whether the historical script plays out or whether the bull market can resume its regularly ordained path higher. Much will depend on the evolution of the larger macro picture. Fact is, major technical damage has been inflicted on markets in 2018. We remain in a structure of lower highs and lower lows on the macro front, and one could even imagine a larger structure that leaves room for lower prices to come in the months ahead. For now, markets have still room higher, as many charts are not anywhere near overbought on the daily or weekly time frames. But this rally has not yet been tested. Earnings reports, economic reports, and coming liquidity withdrawals will likely put this rally to the test during the rest of January, and the test could come at any moment for any reason, as none of the structural causes of the Q4 drop have disappeared or solved. See, the thing is, as marvelous as this rally appears, its structure leaves room for a decidedly bearish interpretation. A rising wedge with weakening internals beneath new highs. So buckle in, nothing's been proven either way yet, and it's early in 2019. Lots can and will happen. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Sand to Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.